Yes, sir. Sir, very happy evening to all. Sir, in our FM quick revision series, this is the second chapter we are doing. As I already told to you the order of study, the first chapter is leverage analysis. I have uploaded a very quick revision of leverage analysis within 15 to 20 minutes. I hope that you have gone through that video and got benefited from that. And we are moving into the second chapter, that is ratio analysis, another a 5 to 7 mark area for examination. Sir, ratio analysis means basically comparison of two figures in the financial statement. We clearly know that we are having trading account, P&L account and balance sheet. In that we will be sometimes taking numerator and denominator both from the trading account or both from the P&L account or both from the balance sheet, that too both from the asset side of the balance sheet or both from the liability side of the balance sheet, or we may interlink the P&L account and balance sheet. Sir, the first one, every entity want to know about the liquidity ratio. Liquidity ratio, right, sir? For example, you may be, sir, lot of money you may having, like, sir, Adani or Ambani or whoever it may be. You may have 10,000 crores of FD. But if you're going to a shop to have a tea, you should have, sir, 10 rupees or 12 rupees to pay that, sir, half bhaji or the tea, whatever it may be. So you should have liquidity with you. For that, we are having specified ratio, my dear lovable students. In that, the first ratio is current ratio. What is the first ratio? Current ratio is equal to current asset divided by current liability. You also tell along with me, current ratio is equal to current asset divided by current liability. Basically, what I am checking is how much current assets I am having to meet my current liability. That's it. It's a simply measure that estimate whether the business can pay short-term debt. Ideal ratio is 2:1. If I am having 1 rupee current liability, if I am having 2 rupees current asset, that's it. That, sir, entity is having good liquidity. I am moving into the next ratio called as quick ratio. So in current ratio, we are checking current asset divided by current liability. In this current asset, we will be having inventory. In this current asset, we will be having prepaid expenses. Right, sir? Sir, you tell me inventory and prepaid expenses. Now inventory is only with me. I have to sell the inventory. It has to be converted into debtor and debtor has to pay me the money. And prepaid expenses means I have already paid the money. Are you really with me? So these are little hard current asset as compared to cash in hand. So what the next ratio is saying, that quick ratio, further you dig it the current assets. That is quick asset divided by current liability. Quick asset divided by current liability. That means from the current asset, remove the hard current asset such as inventory and prepaid expenses. You will be getting soft current asset. Soft current asset. That means which is more liquid. With that, how much, sir, you are having, sir, if you are having 1 rupee current liability, 1 rupee will be the soft current liability, that is called as quick asset. So what we are checking, my dear lovable students, liquidity ratio. Liquidity ratio means in that we are going to check the liquidity of a concern. In that current ratio, current asset divided by current liability. How much current asset I am having to meet the current liability. If it is 2:1, happy. What is quick ratio? Quick asset divided by current liability. What is quick asset? Which is nothing but current asset minus inventory minus prepaid expenses. That is inside the current asset. We are removing the hard current asset. That is coming to the cash ratio. Furthermore soft. That is inside the, sir, quick asset. We are having little more hard. So I will be taking only the cash and bank balances, which is nothing but the, sir, cash in hand, cash plus marketable securities. If I have invested in shares or security, if I click, I will get the money from the share market, right? This is the most liquid one divided by current liability. So in order to meet my current liability, how much current asset I am having is called my current ratio. In order to meet my current liability, how much quick asset I am having is my quick ratio. In order to meet my current liability, the most liquid one, which is cash and marketable securities I am having, is my cash ratio. Sir, basic difference interval. You show like this, man. Basic difference interval. What is basic difference interval? Sir, for example, I will tell you, if you are spending daily 500 rupees per day, your expenses per day expenses is 500. And if you are having 5,000 rupees in your hand, for next year, how many days you will be tension free? 10 days. Because one day you are spending 500, 5,000 rupees is with you. So for next year 10 days, money is available. The same thing. cash plus bank balance and marketable securities, basically cash in hand, divided by total operating expenses, sir, for number of days. That is operating expenses per day. If the operating expenses are 500 rupees per day, and if I am having 5,000 rupees with me, sir, for the next 10 days, I can survive. That is called as basic defense interval. You quickly tell me what is current ratio? Current asset divided by current liability. Ideal 2:1. Sir, join along with me. Quick ratio, tell me very quick. Quick asset divided by current liability. What is ideal ratio? 1:1. Cash ratio means cash plus, sir, marketable securities divided by current liabilities. Everything we are checking in order to meet the current liability. How much current asset I am having, how much quick asset I am having, how much cash I am having. Right, fantastic. Basic defense interval means how much cash in and available divided by, sir, operating expenses per day. Next one is net working capital, which is nothing but total current asset amount minus current liability. That is a net working capital. That is what I have invested in the business as net working capital. I believe that you are very done with the liquidity ratio. Clear? One last time along with me. Are you ready? Current ratio is equal to current asset divided by current liability. Quick ratio is equal to quick asset divided by current liability. Cash ratio is equal to cash plus marketable security divided by current liability. Basic defense interval is equal to cash plus bank balance, that is marketable securities divided by operating expenses per day. Net working capital is equal to current asset minus current liabilities. Fantastic to the core. I'm coming to the capital structure ratios. For example, if you are having balance sheet, surely liability side of the balance sheet shows the sources of fund, right? In that you will be having equity, my dear lovable students. You will be having debt, my dear lovable students. So out of your total capital structure, how much is equity? How much is debt? How much is the debt equity ratio? That's all what we are going to talk about. Equity ratio. The first one is equity ratio. For example, sir, 60 rupees is, sir, equity and 40 rupees is debt. You have started a company with 60 rupees equity and 40 rupees debt. You tell me total 100 rupees is the capital employed. Out of this capital employed, how much is the equity? Shareholders equity is 60. Divided by what is the total capital employed? 100. Into 100 means 60% is the equity ratio. That means out of the total capital employed, how much is the equity component? That's why equity divided by capital employed into 100. Wow, super, sir. Next one, debt ratio. You tell me, you design. Very simple. Out of my total capital employed, how much is my debt? Which is nothing but 40 divided by 100 into 100%. That's it. That is total outside liability. That is debt divided by debt plus net worth, which is nothing but again capital employed. So if 60 rupees is equity, 40 rupees is debt, total capital employed is 100. So out of 100, 60% is equity and 40% is debt. That's it. That is called as equity ratio and debt ratio. Then what are you talking about debt equity ratio? We talked about current ratio, current asset divided by current liability, the same way debt divided by equity. If I am having this much equity, I am having how much debt? So total outside liability, which is nothing but debt, divided by equity, which is nothing but shareholders equity. Comfortable? So can you say the, sir, formula till now? Equity ratio is equal to shareholders equity divided by capital employed. Debt ratio is equal to total outside liability divided by capital employed. Again, you can say the same. Debt to equity ratio is equal to total outside liability. That is debt divided by equity. That is enough. Next one, debt to total asset ratio. I will tell you a very quick shortcut for this, my dear lovable students. They may say that A to B, which is equal to A by B. That's it. Anything to anything is equal to, for example, X to Y is equal to X by Y. That's it. So debt to total asset ratio is equal to debt divided by total asset. That's it. That's it. Fantastic to the core. Sir, capital gearing ratio. Sir, you would have heard about car, right? That will be one, sir, very recently the third position, right? In that there will be gear. For what purpose we are having gear? Gear is there to increase the speed. So inside your capital structure, if you are having preference share capital and, sir, debentures or other borrowed fund, basically debt fund is there. Whatever may be the amount of EBIT you have earned, you have to pay fixed payment of interest, fixed payment of return to those people. So because of paying less to those people, we will be having more balance for the equity shareholders, right, sir? That's what capital gearing ratio, preference share capital, because whatever PAT you are having, you are going to pay the same amount of preference dividend. And sir, debentures, same amount of interest, so they will eat less only. So because of including preference share capital and debt in the capital structure, the speed of earnings of the equity shareholders will increase. So because of preference share capital and debt in the capital structure, the earnings of the equity shareholders are increasing. So they are having a capital gearing ratio. Fantastic, sir. Sir, proprietary ratio. Proprietor means the owner. Out of my total asset, how much is the proprietor fund? For example, if I am having 1000 crore asset and the owner's fund is only, sir, 9 crores or 90 crores, which is very less. If 900 crores is owner's fund, wow, that means 90% of the company is owned by the owner. That's what this ratio is all about. That is proprietary fund divided by total asset. Proprietary fund divided by total asset. Out of my total asset, how much is the proprietary fund? So with this second family also comes to an end. This is called as capital structure ratio. Shall we quickly revise capital structure ratio? You tell me. Equity ratio is equal to shareholders equity divided by capital employed. Debt ratio is equal to, sir, total debt divided by capital employed. Debt equity ratio is equal to debt by equity. Debt to total asset ratio is equal to debt divided by total asset. Capital gearing ratio is equal to debt plus preference shareholder or preference shareholder plus debt divided by, sir, total equity shareholders fund. Proprietary ratio is equal to proprietary fund divided by total asset. Are you able to recall? I hope yes, sir. If yes, share your happiness in the comments, my dear lovable students. Moving to the third family called as coverage ratio. Sir, I'm going to talk about coverage ratio, debt service coverage ratio. For example, for a concern, the main concern will be how I am going to serve the debt. When you are playing shuttle and all, we used to serve. No, what I will serve? The shuttle ball I will serve. Right, sir? Like the same way, a concern should be able to serve. What they should serve, man? Earnings before interest and tax. From this EBIT only they will pay the interest. Right. You will be getting earnings before tax. Sir, from that tax will go. You will get the PAT. Less preference dividend. You will be getting residual earnings. Divided by number of equity shares. You will give that the EPS. Are you all really with me? So the entire EBIT is not only for the debt holders. Because in this one part is interest. Other part is tax. Other part is preference dividend, and other part will go to the number of equity shareholders. So I can't take earnings before interest and tax. That's why to that EBIT we have to make certain adjustment to get the earnings available for debt service. Earnings available for debt service. Sir, to the debt holders, what I should pay? I should pay interest and installment. So how much money is available with me? The same way, current asset divided by current liability. In order to meet the current liability, how much current asset I am having? In order to meet the interest and installment, how much earnings available for debt service I am having? That's it. That's what debt service coverage ratio. Enjoying, sir? Next one is interest coverage ratio. Very simple. You look at here, from where you will pay the interest, man. From EBIT only I will pay the interest. Because if I am having sufficient EBIT, from that I will pay the interest. That's why interest coverage ratio is equal to EBIT divided by interest. Mele divided by kizha. Because from EBIT only I will pay the interest. That means the same logic. In order to pay the interest, how much EBIT I am having? Because I will pay the interest from the EBIT. Fantastic. Now preference dividend coverage ratio. From where I will pay the preference dividend, sir? Very simple, from the PAT. That means PAT divided by preference dividend. In order to pay this much amount of preference dividend, how much PAT I am having? Wow, super, sir. That's it. The last ratio, fixed charges coverage ratio. Fixed charges means I know that sales minus variable cost is contribution minus fixed cost is EBIT. Inside this fixed cost, depreciation will be there. You tell me, is depreciation is a cash item or a non-cash item? Depreciation is a non-cash item. So because of including depreciation inside the fixed cost, automatically fixed cost would have increased. Because of increase in fixed cost, my dear lovable students, sir, my EBIT would have reduced. So that is not the cash balance available. That is not the cash balance available, my dear lovable students. Yes, sir. So what I have to do is I have to take the EBIT, add depreciation. That means I will get the cash from operating activity. You heard about AS3. EBIT is the operating profit. That operating profit is after depreciation. So I have to take the cash from operating activity divided by interest plus repayment of loan. Loan means the principal portion. That will surely be after tax. So in order to make it to before tax, divided by 1 minus T. This is nothing but cash flow from financing activity. Basically, cash flow from operating activity divided by cash flow from financing activity. That's what fixed charges coverage ratio. Super, sir. The second family also comes to an end. Can we quickly recall? Will you also open your mouth? Join along with me. Debt service coverage ratio is equal to earnings available for debt service divided by interest plus installment. Interest coverage ratio is equal to EBIT divided by interest, and preference dividend coverage ratio is equal to, sir, PAT divided by preference dividend, and the fixed charges coverage ratio is equal to EBIT plus depreciation divided by interest plus installment divided by 1 minus T. Comfortable? If yes, share your happiness, my dear lovable students. If this family is very comfortable, sir, just show like this, just like the video, then I will proceed further, my dear lovable students. I'm moving into the next one, man. Activity ratio, efficiency ratio, performance ratio, turnover ratio, shortly called as TAP ratio. TAP, T stands for, sir, turnover ratio. A stands for activity ratio. P stands for performance ratio. Sir, can we come to that? This is one of the easiest slot available. Sir, total asset turnover ratio. I will tell you one thing. Sir, turnover ratio is equal to turnover by that particular item. That's it. Always keep the turnover on top. Because we started with the sales minus variable cost contribution like that. No. So, any turnover ratio, turnover divided by particular item. Now, you tell me, total asset turnover ratio. What is the formula? Sir, sales divided by total asset. That's it. That's what sales, or you can take it as cost of goods sold, because inside the sales profit will be there. So if you remove the profit, you will be getting cost of goods sold divided by average total asset. Divided by average total asset. That's it. Fixed asset turnover ratio. You tell me, sales divided by fixed asset. That's what sales or cost of goods sold divided by fixed asset. Capital turnover ratio. You tell me, sales divided by capital. That's what sales or cost of goods sold divided by net asset. What is net asset? Net asset is nothing but, my dear lovable students, capital employed. Correct? Because the liability side of the balance sheet should be equal to the asset side of the balance sheet. That's it. Working capital turnover ratio. Sales divided by working capital. Sales divided by working capital. Sir, in the question, if the sales figures are available, we have to take the sales. Or if the COGS has been available, you have to take the COGS. That's it. Inventory turnover ratio. Very simple. Sales divided by inventory. In inventory, we'll be having opening inventory and closing inventory. Already we have studied in the EOQ root of 2AB divided by C that I will not consider the opening inventory, not the closing inventory. I will be taking the average inventory, 1 by 2 of the inventory. So cost of goods sold or sales divided by average inventory, my dear lovable students. The debtors turnover ratio, what you should take? Sales divided by debtor. Sales divided by debtor. But debtor is mostly connected with only with the credit sales, not the cash sales, because cash sales will not bring you, sir, debtor. That's why don't say sales, change it to credit sales divided by average accounts receivable. What is average accounts receivable? Opening accounts receivable plus closing accounts receivable divided by 2. Getting it? Sir, this can be expressed as debtors velocity also, which is nothing but average accounts receivable divided by average credit sales per day. Average accounts receivable divided by average credit sales per day. For example, sir, simple sir, if my average accounts receivable is 3,60,000 and average credit sales is how much rupees, man? 1,000 rupees. You can simply take your calculator. 3,60,000 divided by 1,000 means 360 days. 360 days is the velocity, my dear lovable students. Sir, if my average credit sales is 10,000, I am making, man. So 3,60,000 divided by 10,000 comes to 36 days. What it is meaning? Very simple. If I am making a credit sales today, my debtor is taking 36 days to pay off me. That's it with regard to the debtor's velocity. Easy. So, sir, payables turnover ratio, which is nothing but sales divided by average accounts payable. But when I make the sales payable will not come. So I have to purchase. That's what average, sir, creditors. Instead of that, sir, credit purchases. Credit purchases divided by average accounts payable. Divided by average accounts payable. One of the finest family, my dear lovable students. So what is the one line summary? Turnover ratio means turnover means divided by that particular item. For example, total asset turnover ratio. Simple, sales divided by total asset. Fixed asset turnover ratio, sales divided by fixed asset. Capital turnover ratio, sales divided by capital. Working capital turnover ratio, sales divided by working capital. Inventory turnover ratio, inventory. Sir, instead of sales, take the COGS. Sir, cost of goods sold divided by, sir, the particular item. Working capital, inventory. Debtors turnover ratio, you have to take the sales divided by average accounts receivable, but don't take sales, my dear lovable students. You have to particularly take the credit sales. For creditors, you have to particularly take the credit purchases. Are you comfortable? Shall I move to the next family, man? The next family is profitability ratio. Profitability ratio will come from the P&L account, right, sir? GP ratio is equal to GP divided by sales into 100. NP ratio is equal to NP divided by sales into 100. Operating profit means EBIT. So operating profit divided by sales into 100. That's it. Profitability ratio also done. Can you quickly join along with me? GP ratio, GP divided by sales into 100. NP ratio, NP divided by sales into 100. Operating profit ratio, operating profit divided by sales into 100. Expense ratio, my dear lovable students. The opposite of profitability ratio is expense ratio. Sir, if 100 rupees is the sale and 70 rupees is the cost of goods sold, 30 rupees is the GP. How you will represent 30 divided by 100 into 100? That means 30% is the gross profit ratio. If 30% is the gross profit ratio, 70% is the cost of goods sold, right? So cost of goods sold is equal to cost of goods sold divided by sales into 100. Simple, sir. Operating expenses ratio. Operating expenses will be there in the P&L account because we know that there are three overheads are there. Production overhead will be there, administration overhead will be there, and selling and distribution overhead will be there. In that production overhead, we already studied in the costing that this is a product cost, whereas these are period costs. So these two will come and sit in the P&L account. So my dear lovable students, administrative expenses plus selling and distribution overhead divided by sales into 100. That is called as operating expenses ratio. Sir, what is operating ratio? In order to operate my business, I have to sell the goods, plus I have to take care of admin, plus I have to incur the selling and distribution. That's what cost of goods sold plus operating expenses. What is operating expenses? Administration and the selling and distribution overhead divided by sales into 100. What is financial expenses ratio? Like we will be paying interest, we will be incurring, sir, bad debt. Sir, such things are financial expenses divided by sales into 100. Comfortable? Very easy. So that is called as expenses ratio. You tell me, cost of goods sold ratio, cost of goods sold divided by sales into 100. Operating expenses ratio, there are two operating expenses are there, admin and selling and distribution divided by sales into 100. Operating ratio, in order to operate the business, I should sell the goods, cost of goods sold plus operating expenses divided by sales into 100. Financial expenses ratio, financial expenses divided by sales into 100. Getting comfort? Sir, are you able to recall the every formula of the ratio analysis? I hope yes. If yes, sir, I just want to know your happiness by way of comments. Sir, next one, profitability relating to overall return on asset. Very simple, my dear lovable students. Return on investment. This is the next set of formula where return on investment is equal to return divided by investment. That is, look at the name, return on investment. Return divided by investment. What is that? Return divided by investment. It can be either return or it can be profit or it can be earnings divided by investment. That's it. A return on asset, which is nothing but return divided by asset. What is the return? Net profit after taxes. So net profit divided by average total asset into 100. Return on capital employed, sir, which is nothing but return divided by capital employed. What is that return? EBIT is that return. So EBIT, I already told, sir, the asset side of the balance sheet generate EBIT. So EBIT divided by capital employed into 100. These are the various very important formulas for our examination, my dear lovable students. Sir, are you ready to join along with me for the last final wrap up before I wind up the quick ratio revision? Yes, come on. Current ratio is equal to current asset divided by current liability. Quick ratio is equal to quick asset divided by current liability. Cash ratio is equal to cash plus marketable securities divided by current liability. Basic defense interval is equal to cash plus marketable securities divided by operating expenses per day. Net working capital is equal to current asset minus current liability. I hope that every discussion what you have made or we have made is coming to your brain. Fantastic to the core. Equity ratio, what is the meaning? Out of the total capital employed, how much is the equity? Out of the total capital employed, how much is the debt? That's what debt ratio. Debt divided by equity is what debt equity ratio. And debt to total asset ratio. I'm seeing the total asset side of the balance sheet and the liability side only I'm seeing the debt portion. capital gearing ratio, because of including debt and preference shareholders in the capital structure, equity shareholders are enjoying a lot. Yes, sir. And proprietary ratio, out of the total asset available, how much proprietors fund are there? That's what proprietary fund divided by total asset, getting it. Coverage ratio, sir, someone should cover someone. Are you all really with me? So debt service coverage ratio, earnings available for debt service divided by interest plus installment. Interest coverage ratio, who will cover interest? EBAT. So EBAT divided by interest, who will cover preference dividend? PAT. So PAT divided by preference dividend. And fixed charges coverage ratio, which is nothing but cash flow from operating activity divided by cash flow from financing activity, which is EBAT plus depreciation divided by interest plus repayment of loan, sir, divided by 1 minus T. Then the turnover ratio, TAP ratio, simple, sales divided by the particular item. Total asset turnover ratio, sales divided by total asset. Fixed asset turnover ratio, sales divided by fixed asset. Capital turnover ratio, sales divided by capital. Working capital turnover ratio, sales divided by working capital. Inventory turnover ratio, cost of goods sold divided by sir, average inventory, since we are having opening and closing. Debtors turnover ratio, credit sales divided by average accounts receivable. Sir, creditors turnover ratio, credit purchases divided by average accounts payable. Comfortable? Then, sir, profitability ratio, GP ratio, GP divided by sales into 100. NP ratio, NP divided by sales into 100. Operating profit ratio, EBAT divided by sales into 100, or operating profit divided by sales into 100. Cost of goods sold ratio, cost of goods sold divided by sales into 100. Operating expenses ratio, there are two operating expenses are there. Administrative expenses and selling and distribution expenses divided by sales into 100. Operating ratio, cost of goods sold plus operating expenses divided by sales into 100. Financial expense ratio, financial expenses divided by sales into 100. Return on investment, return divided by investment. What is your return? It may be return or profit or earnings. Sir, what is return on asset? Return divided by asset. What is the return? Net profit after tax divided by average total asset. Sir, return on capital employed, return divided by capital employed. What is that return? If it is pre-tax, EBAT divided by capital employed into 100. We have completed, sir, a very quick revision of the ratio analysis. I believe that this is very helpful for you to quickly revise the chapters. My dear lovable students, don't stop with this. You are supposed to do any 5 question from the ratio analysis, at least 3, to get the flow into the chapter, my dear lovable students. This is the second revision. If you want any further more chapters to get revised, just inform me by way of comments, and also how much you are enjoying these revision videos. This is ANM. Are you all really with me? So I'm wishing you all the very best. Sir, do 3 to 5 questions and quickly come back. We will be revising the another chapter in the pipeline. Thank you. Bye bye from ANM.